Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth, and become financially independent. My name is Becco, and my dear Dr. Radhakrishna, my dear partner. Awesome. This is a continuation of our discussion on Southwest Airlines Part 2.
Yeah.
We'll be talking about, in this episode, financials, the management, and the valuation. In the prior episode, we talked about the business, their moat, their relationships with employees, their culture. We talked about all that stuff. So if you haven't checked that out, please check that out before you come to this one.
Yeah, and as with every episode, we go down a checklist that we are halfway through now. And if you want to follow along with that checklist, you can email us at info@valueinvestor.org. You can also send us a tweet at ValueInvestorTV. And this the idea for Southwest Airlines came from a friend of ours who found the podcast, Carlton, and we're happy to and he suggested talking about Southwest. If you would like us to talk about any other company, send us a tweet or email us. We're happy to review and discuss. So,
excellent.
Why don't you give us or I can give us a quick disclaimer.
Yeah, sure. Go ahead.
What we discuss here on the podcast is how we're trying to educate you on how to evaluate businesses the way a value investor would do. This podcast is really for educational purposes only. We're not giving you buying or selling advice. You should really consult with your own financial advisor, before making any, financial decisions. And with that, Becco, why don't we talk a little bit more about Southwest Airlines? So,
Excellent.
We talked about the moat and how we feel that they have a very strong moat with their brand, and their culture and their low cost, provider. But, does that translate into high return on capital?
Yeah. So that's, as value investors, we always strive to find companies with high returns on capital, right?
Yeah.
So when we look at their return on equity and return on capital employed, let's see, the most recent filings. So in 2018, their return on equity from our calculations, about 25%. And that number has been around 25, 26 for about 3 to 4 years now.
Okay.
Before that, it was in the teens, and then it was in the single digit in 2011. So they've really ramped up their return on equity, a high return on capital, as you mentioned. If you look at other measurements, for example, return on capital employed, it's around double digits. It's been around for double digits since 2015, and then before that, since prior to 2015, so 2014 before, it's been around single digit.
Yeah.
So you can see that all in all, they're very focused on getting that number up. And if you look at, actually, we'll talk about this later, but if you look at their management incentive structure, return on invested capital is one of their, it's how the management is incentivized. So, that's one of the criteria that the management is judged by.
Right.
So you can tell that they're really focused on that, and number do show that.
Yeah. So I think one thing that we will do as we go through this, we're going to just do a high level look at their financials here on the checklist. Do they have enough cash to maintain their business, and are they maintaining their debt levels? Based on that.
Yeah. So let's talk about their cash on hand. So the cash on hand is about $1.8 billion in cash. So that's straight up cash, actual cash. But they also have short-term investments of about 1.5 as well.
Right.
So all in all, they have 1.6 or 3.6, 3.8, around there.
Just so everyone understands, because I think this may be confusing to some people, what is a short-term investment? Remember, so current assets are things that will be converted into cash within a year.
Yeah.
A lot of companies, what they do is they will take cash on hand and buy like a treasury bill, like a 3-month treasury bill. So balance sheet is a snapshot in time. So that means that at that moment when this is done, for that date, this was in, this cash was in a short-term, vehicle like a treasury bill, and it'll get converted back into cash within a short period of time. So you can consider anything that's in a short-term investment as basically cash.
Exactly.
Right? And some people will report cash and short-term investments all together. So
yeah, great point there. Great clarification. And if you find this kind of confusing, check us out on the podcast. We actually recorded a podcast on financial statements way back. So check those out. So in terms of your question, so they have, about $3.7 billion in cash or cash equivalent. In terms of debt, they have about $3.4 billion in debt. And in our value investor kind of thesis and analysis, we want to make sure that the debt level is manageable, and it's me. Let's say...
so when we say manageable, there's kind of two metrics you want to look at.
Sure.
Right? One is the debt-to-equity ratio, which, in their case, you want that number to be below 1.
Yeah.
And so that number for them is...
let's just see here. We're looking at our graphs here. So, equity of $9.8 billion, and then their debt is 3.4.
Yeah, so it's less than 0.5.
Yeah.
Right? That's pretty good.
Yeah.
And then the other one that you want to see is that roughly their free cash flow can pay off that debt in 3 to 4 years.
Yeah.
Right? And so, what is that free cash flow, which is their net cash flow from operations minus their capital expenditures? What does that look like?
Let's check it out here. Yeah, it's about 3. Yeah, it's about 3.
So they'd be able to pay it off in less than 2 years, right? Probably like a year and change.
And on top of that, they have 3.6 in cash reserve.
Right.
So I don't see a problem with them paying off the debt.
Yeah.
Right.
Yeah. So that there's no immediate risk for them to go under, right?
Yeah.
Which is always a good thing.
Right.
So then the real question is not just about risk to go under. It's about, they have enough current assets, current things. So there's that, and it looks like they have plenty of cash available.
Exactly.
So if they need to sustain a downturn, we talked about the 737 MAX line that was causing problems for them. Will that be a problem going forward? Doesn't sound like it. Okay, so talking through that, we've kind of looked at the financials and gave us just a brief overview. Let's move on to management here.
Sure.
I think it's worth noting here that they've had 2 CEOs. Herb Kelleher, who's the founder of the company and was the chairman for a very long time, and he recently died, I think, last year.
January 3rd.
So it was 2019. Is considered, is one of those CEOs that you should learn as much about as you can, right? Fantastic CEO, kind of had to fight a very tough uphill battle from going from those 3 planes to, that, right? And so one of the things I would say is whenever you look at businesses where you just say, company's crushing it, there's always a kind of a similar story, right? The founder's still running it, or the founder's culture and values are still there. You look at Disney, right? Disney was founded in the 20s and 30s, but they have the same culture around their CEO and that kind of stuff. And they even, you see Walt Disney pictures everywhere and that kind of stuff. Herb Kelleher is the same thing. I was getting off a plane last week or 2 weeks ago.
From Chicago?
Yeah, from Chicago, coming through Hobby Airport, and they had a memorial to Herb Kelleher that the employees had just made.
Wow.
Not like a formal thing, but like, so in memory of that. So I just to kind of tell you how important that culture is and how that, so this management structure that they had, it's rare that you find great management. Most of the time they are hired guns. This guy had a personal interest, and then the new CEO that took over, Gary Kelly, is also fantastic. So, it's rare that you see that. So if you guys are just trying to learn about good management, I would look at these guys. So with that being said, does management have the proper incentives to protect shareholders.
Yeah. I thought their incentive structure was really interesting because it's a bit more complicated than the other companies that I've analyzed. Other companies, it's usually sales target or EBIT target or some combination of that and total shareholder return, things like that. What they did here was this. So I mentioned return on invested capital early on. So they have target goals for those, but they also have other strategic and business objectives, such as technology initiatives. So were they able to bring in new technology initiatives into companies, or fleet modernization? We talked about Max 8 as being kind of a key driver of their modernization effort. But they also have what's called a Net Promoter Score, which is something that was championed by Bain Capital, and it's widely used in corporate America and corporate world. It's a measurement to find out how companies are liked or loved or hated by their customers.
Yep.
So they definitely have that in there. So I thought it was interesting that they've kind of have all of this as their objective. So in terms of going back to your question about in terms of shareholder incentive alignment with shareholders, I think it is certainly the case that ROIC, if ROIC is one of their big focus, that's directly aligned with shareholder interest, as well as making sure that the business culture stays intact with these metrics like Net Promoter Scores, as well as staying on top of technology shifts and modernization efforts with these scoreboards.
Yeah, and excuse me. I think it's important to remember that management incentives don't have to be EBIT targets for companies that are mature, right? Southwest is not going to hit 25% growth anymore, right? Mm-hmm. That's just not going to happen on a top line basis. So they're not going to be focusing on that. And I would want to see, like when we ask this question, we're really asking, do they have the incentive that aligns shareholder interest, which is, maximizing my return, and and the company management interest, right? Mm-hmm. So are they going to do different things? And so return on invested capital is a fantastic metric mm-hmm. to measure, right? Because it's making sure that you're not blowing my money on useless incentives, right? Or useless business lines. Okay, so how let's talk about the management's use of excess capital.
Yeah.
So I think this is an important discussion because do companies have good use of that capital that they're generating? Southwest is now a mature business. Mm-hmm. So what are they doing with that excess cash?
Yeah, so they're buying back a ton of their shares, and also they're doing the big dividends. So last year they gave out $300 million in dividend, and then $2 billion in share repurchase program last year.
Yeah, and for to kind of give us a scope of how much that is.
Yeah.
How many shares did that translate into?
Let me see here. So from 2017 to 2017 you had 600 million shares. In 2018 it went down to 573. And if you look at number of share counts, it's been going down steadily because of the share buyback program. So if you take a look at starting from let's say 2011, at the height of the stock number of shares outstanding for Southwest, it was at 778 million shares. From that point on, it has been steadily declining to about 573 million.
So they've retired about 200 million shares.
Exactly.
Yeah, and if you remember back to our NVR podcast, which was we discussed, NVR retired about 70 or 80% of their shares in 20 years.
Yeah.
Which is a fantastic kind of return.
Right.
What that translated into was their return on the top line was only about 8%, mm-hmm. but it translated into about a 30% growth in earnings per share.
Yeah.
Right. And so, what we see with Southwest is kind of a similar thing, that they can return a very high kind of amount to their shareholders back by just doing this buyback, right?
Yeah, exactly.
So going and looking at that, how is that kind of translated into an earnings per share growth versus their revenue growth?
Yeah, exactly. So Earnings per share, like you mentioned, earnings per share definitely is a right metric to look at, because for share capitalization for a company like this, it's per share that really matters, right? And as shareholders, that's what matters for us too, right?
Yeah.
We're not buying. I mean, per share is what really counts.
Yeah.
And so let's take a look at that. So from 2000, let's say 2000, I said the height of number of shares outstanding was 2011. So per share outstanding, it was at 23 cents per share, and now it's at $4. $4 per share. Yeah, exactly. And then if you look at the top line growth in 2011, it was about 15 billion, and then it's now 21 billion.
Yeah, so their growth has only been 30%.
Yeah.
Top line over a 7-year period.
Yeah. Let me give you a little bit more stats on that, actually.
Yeah.
So if you look at the top line 3-year and 5-year and 10-year growth rate, compounded annual growth rate, 3 years, let's talk about top line first. Top line 3-year growth rate, about 3%. 5-year growth rate, 4%. 10-year growth rate, 7%. So that's historical growth rate going back 3, 5, and 10 years for top line. And if you look at EPS, this is pretty stunning here. Past 3 years, the growth rate has been 9%.
And the caveat, we'll finish. We'll talk about the.
So compounded annual growth rate for the past 3 years has been around 9%. The past 5 years, 32%, and then the past 10 years, 33%.
Yeah.
So compare that to what I mentioned earlier about the top line revenue. The growth rate is pretty stunning if you look at EPS versus just top line. What were we going to say?
Yeah. So for them, the last 3 years have also kind of been affected by the Tax Cut and Jobs Act. They had to take some tax liability hits, like every company did in 2018.
Yep. So
there could have been higher than it was. So that 9% number may be artificially lower than it could be. But I think the thing is that this gets into they're returning about $2 billion back in share buybacks.
Mm-hmm.
Their stock price is around $50.
Yeah.
So let's just call it, for easy math, $50.
Sure.
Right. So they can return about 40 million shares, back, right, which translates into about 7 or 8% reduction in their share count.
That means if the earnings stay the same, it'd be 7%.
Yeah, just a bump in 7% every year, just by buying back their shares, right? So you have a floor now, essentially, assuming that the price doesn't skyrocket, of 6 to 7% a year that you're going to get. Now, they're also going to see some growth on revenue and some growth in other areas. But I think what you're going to get, from a company like this is, over time, remember, it's compounding, right? Mm-hmm. So at some point, it's going to be, that continued shrinkage of their share count is going to translate into a huge, numbers, just like NVR was.
Yeah, exactly. That's what you're looking for, really, at this stage of the company, right? You're looking for, if you're looking at mature companies, that's what you're looking for.
Yeah, right. And honestly, the dividend to me is not even interesting, right? Like, who cares? I would rather them buy back these shares, and in 10 years, I'd have a huge, huge growth in their share price, purely because of the cannibalization of their shares, right? It's a twofold effect. Their EPS goes up, but then the number of shares outstanding decreases, and that creates... okay. Yeah. So I think we've kind of already covered this with the management's honesty and openness. Mm-hmm. Like, I don't think there's any question or red flags there.
Mm-hmm. Yeah, I agree.
So let's move on right now to what our valuation is. So give us your assumptions on how you put this in.
Yeah, let's take a look at that really quick. So let me see. Yeah, if you look at discounted cash flow. So discounted cash flow is something that we use to evaluate, kind of project out the future cash flow of the company, and then we discount that back to present time. And that's how we estimate the value of the company. If we do that, we take the initial free cash flow for about 4, and then we project out with growth rate of 15%, 10%, and 7%. So 15% for the first for the first 3 years, 10% for the next 3, and then 7% until the year 10. And then discount rate 10%. That's the standard that we use. You give it a little plug for why we
basically
use 10.
The S&P 500 plus dividends is about 10%.
Yeah.
Or it's about, I think, 9%, and we just added to make it 10.
Simple math.
Yeah.
Yeah. So that's what we use. Discount rate of 10, and then like I said earlier, the growth rate 15 for the first 3, 10 for the next, and then 7 for the last.
And let's make the caveat, or so you understand why we're picking those numbers, right?
Yeah.
We're using not the top line growth rate, because that's not what we care about as investors. We care about the money that we get, right? Which is, how is the cash flow per share going to change, right? So we know that they have an aggressive share buyback, which is going to reduce share counts significantly. So that number is really the earnings per share, which was actually much higher, 30%, over the last 10 years. So those numbers, I think, are fairly reasonable, given the, that it won't continue to grow at the same rate, because it started from a small number.
Exactly. Yeah. So we're looking at per share again here. We're not looking at the top line, just the purely top line or the bottom line. It's per share bottom line, per share free cash flow. So we do that, we project it out, and then we obviously have the debt level and then the cash, assuming that we pay back all the debt and then get all the cash into our system. The intrinsic value turns out to be about $80. And right now it's trading at 50 something.
54, yeah.
54, yeah. Go ahead.
Well, so we talk about margin of safety first, right? Which is, we want, a 50% margin of safety would give us a price of around $40, right? So they're a little bit above that. Some people use less margin of safety, 30%. Some people use more. But where that really falls into is, how comfortable are we at estimating their future growth, right?
Right.
And truly, that this is a business with a very, very strong moat. So is it acceptable to take a smaller margin of safety because the moat is actually is your margin of safety in this case?
Well, I think the answer is yes. I think it's an astounding yes for that one, because if you look at the best investor of all time, Charlie Munger and Warren Buffett. Charlie Munger talks about this all the time, right?
Yeah.
It's better to pay fair value for a great business than great price for a fair business.
Right.
And this is definitely a former case on that one.
Yeah, I think it's a great business, and we use these assumptions. Obviously, if you were to start a position in this, right, if the price were to go down because of a recession or what have you, that doesn't necessarily mean that the value of the business has changed. I would buy more, right, as if the price went down, obviously, because I don't think this business is not going to go away. They're not going to get disrupted by the internet, right? That's not going to change anything, right? People just need to get from point A to point B, and this is the best way to do it. And I think there's a lot of preference for people to use Southwest Airlines.
Absolutely. Yeah. I think one of the things that I want to talk about here is the idea of airline industry being always undervalued.
Right.
We talked about this earlier on outside the podcast, but can you maybe shine some light on some people that might say, okay, I don't want to get into airlines because airlines are always undervalued. This is always going to be undervalued, no matter what. So it's never going to achieve that intrinsic value. Yeah,
and I to them I would say NVR was also undervalued, and they've had a compounded annual growth rate of 33%, which is taking every tech company and all these other places, and taking them behind the woodshed and beating them in terms of returns. So undervalued doesn't mean anything. If the company is a great business, don't worry about what the market is going to do or how they're going to price it or whatever. None of that matters. It never does. If you own a great business, you will always be rewarded as long as you pay a fair price for it, right? And that's the thing, is time is always your friend when you own a great business. So if you buy a great business at $50 a share or $53 a share or $47 a share, it doesn't really matter, right? If there's a significant margin of safety and they're a well-run business like Southwest is, you're going to see a return on your investment, and that return is going to be predicated on the great business, right? Because they will generate cash and they will give it to you in some way. Yeah. Right.
Yeah, exactly. The last point, I think they will give it to you in some way, and this one is, they'll give it to you in share buyback, and the value of your ownership of the company will grow because of that.
Right.
And and kind of to your point about market, kind of answering my own question, right? It doesn't really matter what the market thinks. Market might give you, let's say, for airline industry, the PE of, I don't know, like 5 or 6, whatever. It doesn't matter if the PE is PE never goes up to 10 or 11, as long as the per share price, per share earnings keeps growing like it has, and it keeps just buying his shares. So what the Wall Street assesses is the right PE for that industry is irrelevant if the company is continuously buying back their shares, because it is eventually going to have to go up.
Well, and we've talked about another company that's in the transportation business, as they would like to call themselves, which was Lyft, and I mean, they're not generating $2 billion in free cash flow a year. They never will, right? I mean, maybe they will. I don't know.
Yeah.
I don't have enough foresight to see how that looks, but I can look at this business and say, and Lyft's PE is outrageous, and it's based on a growth pattern.
Negative.
It's infinite, right?
Infinite, yeah.
Because you have no.
There's no earnings.
There's no earnings, right? It's basically zero, and dividing by that price, or price divided by that that earnings is giving you an infinite value, right? I don't know how to take that into account when I have a business. Why would I even look at that company when I have a company that's who cares if it's chronically undervalued? They're going to return cash to me. I would much rather buy an undervalued business than an overvalued one, right?
For sure.
And then if I have a great business, that solves a lot of my problems, right? I don't even have to worry about this. Like if I forget to, look at the conference call transcript or whatever a quarter, who cares? I know Southwest is going to be there. It's going to always do well. It's not going to change. I mean, unless somebody invents an instant teleporter, right? You're going to need Southwest Airlines. And so I feel like this is a business that is very well run, and you're going to be well taken care of by that. And the same thing with NVR, right? I think the higher, the bigger point of all of this is value investors look in places where other people don't. No one is talking about companies like Southwest Airlines or NVR or these others, but yet they're giving you the best rate of return, right? You and I don't get any benefit. I don't get the warm fuzzies by owning Uber or Lyft or any of these other things, right? All I care about is making money, right? And at the end of the day, that's how you do that, is buying these kind of companies.
Yeah, exactly. What's crazy is, just last point before we close out, what's crazy is that the market cap of Southwest is $30 billion. Uber IPO'd, is expecting to IPO at like 100 or something, 90 billion. So just to give you guys some perspective about that, like this is, Uber is 3 times as more valuable in people's eyes than Southwest at current valuation, which take it or leave it, but it's very, very bullish. Very, very bullish. Maybe a little too bullish from our perspective. But
well, one company actually makes money, the other one doesn't. So
it makes a lot of money too.
I'd rather not that my equity just be set on fire. I'd rather actually have a business that generates cash for me. So.
Well, awesome. That was a good discussion about valuation and management and financials. I hope you guys enjoyed our podcast, Southwest Airlines Part 2. Please do reach out to us like Carlton. If you have any suggestions on companies that you would like us to cover, please do send them over our way at info@valueinvestor.org, info@valueinvestor.org, or reach out to us on Twitter. Value Investor, the handle is Value Investor TV, Value Investor TV. All right, guys. Thank you all for listening, and we will see you on the next episode.
Yeah, thanks.
Thank you.